Okay, in this tutorial, I will be going through with you um, with a symbol OTEX of stock, and that's the symbol in Nasdaq. And let's see how the stock is and what's the current situation. I'll just copy this and I'll paste it in Google and type in stock. Okay, besides it. And it tells me in Google that the name of the stock is Open Text Corp or Open Text, and it's a software company. And if you see on the right hand side, the information is from Wikipedia, and on the left hand side, it's from Google. Now let's see what it is. So if I really want to buy this stock today, I just want to know what's the price, current price. It says 41.26 US dollars, which is USD. I'll just copy that and I will paste it here. And okay, and if I am interested in knowing that how old is the company when it was formed, I can just go to Wikipedia and I'll just zoom it here. You can go inside the Wikipedia, or it's just written outside, founded 1991. If it's not written outside, you can just click in Wikipedia and I'll just zoom in for you, and it says founded, so that's stable. It says founded and that's 1991, which is 28 years ago approximately. Let's put it here. And then it says that then it says the sector. I'll explain you from where I get the sector. Then it says that I'm just interested in, when I'm scanning the stocks, I'm interested in four main ratios. And the best website that I've found to compare the ratios, that calculate the ratios on itself, is Macrotrend. And you can get the link from the YouTube video in the description. And then you just click on the price, okay, ratio, and then price book ratio, and I'll just paste the symbol of the stock, or and compare. And also I need to be sure that it's written open text besides, because there are many stocks with the same symbol, so you might be mistaken, so you need to make sure that the name matches. So right now I'm just looking at price book ratio, and the price book ratio should be 1, or um, ideally it should be less than 1. So it means you'll get the, if it's less than 1, it means you can get the stock at bargain, at discount. If it's 1, it means that the book value, or the, which is the real value of the stock, and the stock price in the market is same, if the ratio is 1. If it's more than 1, it means that the stock price in the market is more than the real price or the book value of that share. So you are buying it expensive if it's more than 1. Let's see. It's 2.89, which means that the you're buying the stock 2.89 times more expensive than its real price or the book value at the moment, which is expensive. But in December 2018, it was 2.31, which means it was 2.31 times more expensive. So right now, the stock is more expensive than in 2018, but still you're paying 2.31 times more amount in 2018. So if you just see vertically up, if you just see that the real price or the book value is $14.10, and you are paying, or the person who is buying at that time is paying $32.60 for an item or a stock that is equivalent to $14. So like um, they're paying like, I mean, 2.31 times more money, which means expensive. And the lowest the stock went was in 2012, when it was, you could buy $5 5 pence stock worth, you could buy it of £11 37. So still you're buying it expensive, but right now it's 2.89 times expensive, so you need to be careful about that. Then if I go to other ratios, I can see the current ratio. If the current ratio is 1.5 or more than that, then that means that you have good margin of safety, that you have a lot more assets than liabilities, so you have margin of safety, which is good, it's less risky. But if it is less than 1.5 ratio, then Still, you have more assets than liabilities, but the margin of safety is very narrow, so it's risky if it's less than 1.5. But it should be at least 1, which means that the current assets equal to liabilities if it's 1. But if it's less than 1, then it means the liabilities are more than the assets, and that is very dangerous for the firm. So let's see. Right now, we have data until March 2019. We don't have the recent one, but let's see that one. It's 1.38. So it's the assets are still more than the liabilities, but for it to be a company to be having a good margin of safety, to be less risky, it should be 1.5, but right now it's 1.38. So let's see the previous ones as well, because we need to know that is it once off, or is it maybe we can get one more than 1.5 in the previous ones. So let's see the consistency. So 1.33, 34, and that's 0.98. This means that if you just look vertically up, you can see that liabilities are 1.3 and assets are 1.27. Assets are less than liabilities. So this is scary because that's not the right ratio. It shouldn't be less than 1, then it's risky. So here also it's less than 1.74, 0.89, 0.81. So in 2017 it has been less. A whole 2017 it has been, the assets has been less than liabilities. Then in 2016 it has been more. So it's just fluctuating up and down, so it's a bit risky stock. um, it has not been consistent in being 1.5 or more than that, but it has fluctuated. So in 2011 the liabilities were more than the assets. Again, it's 0.73 ratio. And you can just see vertically up, the liabilities are more than the assets. So it's very risky to invest in here then, because the current assets are not a lot more than liabilities, and sometimes, many times, liabilities have been more than asset. So you need to be careful about that. Then if I just go to debt equity ratio, if the debt equity ratio is 0.5 or less than that, that means that there's a margin of safety. If the company is operating more on debt, then it's very bad for the firm. And if it's operating more on equity compared to debt, then it's good for the firm. So it should be zero point 0.5 or less than that. Right now it's 0.68, which means that if you see vertically up, it's operating more on equity, which is 3.84, and long-term debt is 2.61. So equity is more, but still the ratio is 0.68. It should be zero point 0.5 or less than that for it to have a good margin of safety. But it's 0.68, which is not very good. And then it's 0.69 previously, 0.70, 0.65. So if I just go back, here it's 1.08. You can see that long-term debt, vertically up, you can see that long-term debt is 2.14, equity is 1.98. So here in 2016 June, the equity is less than long-term debt. So this is scary because the company is operating more on long-term debt than on equity. So this is not very good. And if you just see back, you know, it's rarely like if I see that from 2007 December up till 2013, it has been operating mainly on equity. So it has been less than zero point 0.5, the ratio, which is very good. But then it has increased from 0.5. So from 2013 onwards, the ratio has not been very good. So, you need to be careful about that. Let's go to return on equity. If the return is 8% or more than that, then it means there's a good margin of safety. The stock is secure, it's giving good returns. So right now it's 7.3, which is, little bit less than 8. It should be 8 ideally or more than that, but let's look the previous ones. 6.9 and less, no, that's okay. 4.26. So that has been very less, you know. And then if I just see in 2017 June, it's 30%. Okay. So if I just go back, yeah, it's fluctuating. So like again, from 2009 up till 2016 June, the return has been really good, above 8% or 8%. From June 2016, went very high. It's really good. But from 2017 September, the equity has been very low, a lot less than 8%. I know there's a return. 1% return is a return, but it's a positive thing. But still, it should be 8% or more than that for it to have a good margin of safety. And then if I look at the dividends, if the company is financially good, it will most likely it will pay out the dividends. Let's have a look. I'll just copy the symbol and I will paste it here, and let's have a look. So I can see there's a dividend yield which is 1.69%, which is a good thing. It means that the firm, even if the dividend yield is very less, it's 1.69, it's not very much, it's a good thing, because that means that the firm is able to generate enough finance for it to give to its shareholders. So it has money that it can give to shareholders, instead of, even though it will invest the money in the firm, but still it has a leftover money that it can give to shareholders. So dividends are good sign of financial stability. So because companies usually pay dividends, that means they are generating good money. They're financially good. Then let me have a look if it's a billion company or a million. What's the market cap? You can just have a look at the market cap here. It's a billion company, 11.13 billion. And okay. And if I want to see if it has any patents, I'll just go to Justia Patents and I'll just click here. Okay, you can see the website link in the description. I'll just copy open text and I will paste it here. I'll click enter, and actually what I'll do is I will just copy the stock symbol and I will click here and right beside it stock. Okay, and I will just copy the exact name from here, okay, from Wikipedia for example, and I will type it here and click enter. Okay, so it doesn't match. Then I will do is I will copy this thing maybe and from Google, and I'll just paste here. No, I can't find any. Okay, I'll just say open text. Let's see if there is any, because sometimes no, I can't find any patents for this firm. Then that's fine. And if I just type in the symbol, maybe there is. No. Okay, that's great. I can't find any patents, so it means that patents are very good if some firm have, because that means that they have extra competitive edge. It's a moat. It acts like a moat. So patents, if some firm has patents, that's really good. Then if I go to Yahoo Finance, okay, I'll just show. I have the link in the description, and I can just type in the company open text, or I can just say OTEX. I'll just write the symbol and make sure that the name of the firm matches the symbol, because sometimes there are other firms as well with the same symbol. I'll click that and I'll go to profile, and from here you can see the sector, which is technology. Okay, which is technology, and the sector software application industry, and full-time employees 13,000. And then the best thing about this is I want to know that if the key executives, who are the key executives, and their title and their pay. If the pay is shown, so here I can see that all the key executives who are working have their pay shown here. So this means that this company is very transparent in that way, because the more the information about the salaries, the more better the firm is. So it's more transparent, so they have less to they're not hiding anything, and which is good for the firm. So everything is investors can see everything. and they have shown all the pay, all the salaries of people. And if I just type this firm and I go to Indeed and I click in review, and if I just want to see people who work here, what they think about this firm, I can see 3.6 stars they have given, which is very good stars. And there are 314 reviews altogether, so which is quite a lot of reviews. You can read through it and you can just see that, what people who work here think about it. If I just type here Glassdoor reviews and I'll just click here, and let's see, um, in Glassdoor, let's see. So we have like 1.5k, which is 1500 reviews, which is a lot of reviews, more than Indeed, and it's 3.1 star. So 1500 people have given 3.1 star, and you can just read through it if you want, because employees are, one of the source that tells how it's like working in this firm, and which tells you a lot about the firm as well. So which is very important.